All right, so guys, we're going to do this webinar today on swing trading strategies for beginners. If you are new to swing trading, this is going to be kind of more of a high level overview, kind of go over some of the basic concepts. I'll show you some examples as well. Just to skip forward, if you have, in-depth questions, we do have courses on our website at bullishbears.com that can really help you more in depth. We have a swing trading course, couple options courses. We have basic course, day trading course, candlesticks, all that good stuff. So again, this video is going to be more of an overview. So I'm going to kind of start off and kind of go in, show you guys some examples. For those of you guys that are watching on chat and in the room right now, I'm going to answer your questions more at the end. You guys know me by now. I kind of just get into my rhythm and I go into everything, lose my voice, and then I'll save the questions for the end. So if you guys are listening in chat, I'll get to your questions towards the end of this. So this is going to be, again, on swing trading strategies for beginners. So what is swing trading? Now, everybody kind of has a different, there are different thoughts on what swing trading is. Typically, it's holding for a few days up to a few weeks. So holding stocks, or you could trade options. So again, you can swing trade shares of stocks, and you can also do options, right? Futures is popular too. You just got to be a little bit careful with the larger, margin requirements. So if you're swing trading futures, just be aware, depending on the broker that you use, the different margin requirements that are required. And you also have to be careful, especially if you get the wrong entry. Futures are extremely volatile, so you don't just go swing trading futures without knowing how to trade futures, right? Larger cap stocks are the safest to swing trade. Right? Larger names like Facebook, Apple, Netflix, Google, AMD, stocks like that. Penny stocks are also very popular. You just have to be very careful swing trading them because of the pump and dumps, right? So if you get in before the pump or you're buying at support levels, you can swing trade them. It's just a little bit more difficult to trade, because of the patterns. Once they get that pump up, and it's hit the resistance and they dump back down, you got to be very careful because, if you get a great entry, you can hold a little bit longer, but the volatility and the huge high wave candles and the dumps, it's not as easy to swing trade penny stocks. That's where, doing your research, your fundamental research, there's a lot of people that know, that'll research, fundamental traders will research penny stocks and they'll be able to get better entries on a penny stock before a technical trader many of times, because technical traders are looking for the patterns, whereas fundamental traders might get in on the news or on the pump on the way up. So they get, many times better entries with penny stocks. So ideally with swing trading, you'd like to risk off of small candlesticks near support levels. That's pretty much the same with any type of trading, not just swing trading. You want to buy low, sell high, and minimize your risk, right? You want to look for reversal candles away from moving average lines for potential exit. So, as a stock breaks out, again, moving average lines, they're more of a guide, right? They're not foolproof. They're lagging indicators. So as price moves away from the moving average lines or breaks out, you look for those little doji reversal candles, spinning tops, stuff like that to potentially take your profits and look for pullbacks for reentries. So let's go next one here. Oops, there we go. So what you want to do is you want to watch for potential exits on breaks of trend lines as well. So you can look for reversals on the small candlesticks that break away from those moving average lines. So kind of like stocks are like rubber bands, right? The more that they break out, the more that they want to naturally gravitate or snap back towards those moving average lines or back to the equilibrium, right? So, you have those overbought, oversold levels. So when a stock rips or breaks out, again, it'll want to snap back towards support levels. And also when price fails, and when it's dumping and it's getting oversold, again, a lot of times it'll want to snap back to those equilibrium levels. So another thing you want to look for is, closes below the 9 or the 13 EMA. Again, moving average lines are guides. They're not foolproof, but very popular moving average or exponential moving average lines are the 9 EMA and the 20 EMA, or another popular one is the 13 EMA. So if you like the 9 and the 20, you don't really need the 13 EMA. If you like the 13 EMA, you don't really need the 9 or the 20. So when you look for, again, a few things for potential profit taking or exiting a trade. When price breaks out, it gets away from those moving average lines. It has those smaller reversal doji spinning top candles. When price starts to fail the 9 or the 13 EMA, it might be showing a potential momentum shift. Again, just because you get a close doesn't mean that it's going to fail. You have to look at other candlesticks and patterns. Again, if you get a close below the 9 or the 13 EMA, but you had an earlier entry, you might be able to ride it out a little bit longer. But just when you start seeing candlestick closes below the 9 or the 13, it might be showing a potential shift in momentum. So again, popular exponential moving average lines or EMA lines are the 9 and the 20 or the 13 EMA. Now, popular simple moving average lines or SMAs are the 50 and the 200 SMA, as well as the 100 SMA. I'm going to show you these on my chart in a couple moments. Now remember, moving average lines are lagging indicators. They're meant to be used as a guide. Candlesticks and volume are definitely the most important trading indicators. So let's talk about trend trading first. Again, I'm going to show you some of the kind of the basic or the most popular swing trading styles. There are so many different ways to trade, but I'll show you some examples of some of the most popular. Now, trend trading, you can ride that 9 EMA up, like I was telling you about, or the 13 EMA. And you want to look for bull flags, pennants, triangles. So if you're bullish, right, and you're riding the trend up, look for things like bull flags, pennants, triangles. Look for little reversals off of moving average lines. So when price pulls back, again, that many a times that's the consolidation or the flag, formation forming. And on the inverse, right? So if you're riding the 9 or the 13 down, you're in a downtrend, you look for things like bear flags, pennants, triangles. Again, if you're not familiar with candlesticks or patterns, we have our courses on our website. We have a free candlesticks ebook. We have a couple courses that'll really help you. You got to take time to really learn these patterns. It takes some time, hundreds. It takes, several months and looking at a few hundred, if not a few thousand charts for these patterns to really start to jump out at you. Now, you want to look for, again, potential candlestick close of half or more of the real body below the 9 or the 13 EMA when you're long, and an exit when you're short with a candlestick close half or more above the 9 or the 13 EMA. I'm going to show you a couple examples in a moment. And again, you want to look for trendline breaks of support to exit a trade. And you want to watch for trendline rejection of resistance to take profits. So you look at those reversal candlesticks that I was telling you about when I'll show you guys. Again, moving average lines are a guide, but you also want to be able to draw your trend lines. And many times at resistance levels, you'll see those reversal candlesticks forming right at the tops of trend lines. So let's take a look at some examples of trend trading. We'll look at the SPY, Apple, and GE. All right, so SPY basically just tracks the market overall. It's an ETF, and it's heavily traded. So it's a really great product to trade. If you're trading trends, you can do options, you can do shares of the SPY. And it's a really good gauge that tracks the overall market. So when they say the market's up, if you look at the SPY, right, stocks run with it. So if the market is in an uptrend, typically a stock, let's say like, Apple, will be in an uptrend, right? And you'll see many of these, the Apple, you'll see kind of right now, we'll look at a formation right now of kind of like it's a rising channel, right? You'll see many a times, so price is kind of in this kind of rising channel. When I look at the SPY, kind of going over to the SPY, you'll see it's got the same type of channel. So you'll see if you look at a lot of these major stocks, they'll have very similar patterns to the SPY, right? So if the SPY is running up, these stocks, or typically stocks, will run up with it. If the SPY is falling, typically, again, you'll see right over here, kind of what I'm doing right now is connecting trend lines right here, just kind of connecting peaks and valleys. Again, on our courses, we teach you how to do trend lines and all of that good stuff, but you'll see it's basically connecting as many peaks and valleys, or valleys and peaks, as possible. And you'll see kind of that trend down and then kind of a newer trend up. I'll show you moving average lines in a moment. But when I go back over to Apple again, right, you see the kind of the channel up. Well, you can see right here, kind of a channel falling down, just like you would with the SPY, right? So you'll see Apple runs heavily with the market. Many of the larger cap stocks do. So learning how to draw trend lines, super important, right? So the trend is your friend is a very popular strategy, or I'm sorry, very popular saying. So if you're looking to, be bullish on a stock, you obviously want to ride that trend up. You want to have a nice clear trend up or heading upwards. If you're bearish on a stock, you like to see it kind of a nice trending downward, trend going downwards. Now, again, you'll see, many times you'll want to do something with trading, and then you'll have the choppiness, right? The choppiness. This is what's happening from obviously Corona, lots of uncertainty in the markets. You'll see kind of a market will trade sideways, and it's got to decide, is it going to keep falling or is it going to continue going up? And you'll see like kind of areas up top, these consolidation areas, you'll see it many times at, let's see here, support and resistance levels. You'll see these like consolidation areas or these ranges, right? It'll trade in a range because the market hasn't decided, or this is Apple right now. Apple hadn't decided whether it's going to continue upwards, right? You'll see kind of this, right? Kind of almost like a range, right? So it's kind of trading inside of this range because Apple, or any stock, right? I'm just showing you Apple right now. Apple hadn't decided up here whether it's going to go up, if it's going to continue upwards. So if this is going to be a breakout and continue with this uptrend, or if it was going to fail, right? So as it's trading sideways, once it started to fail that support level, then it created a downtrend. So you can connect these kind of resistance, peak valleys, support levels. And then, once you'll see down here, some consolidation starts to happen, right? Market's got to choose a direction, kind of a shift, what's going to happen. And you'll see it reversed, and then it created, now it's in a new uptrend, right? However, you got to look at these other things. Again, support, resistance, patterns, all of those things, where just because it looks like it's an uptrend again, it could fail. You have to learn these, the patterns. You could see like basically a falling wedge or a falling channel and a rising channel. If price stays in this channel upwards right here, many times it might hit support, go up and bounce and go around. This is great if you want the market to be bullish, right? However, if price starts to fail this channel, this support level, then it's potentially bearish. And if it fails, then you start looking at support levels below, right? So kind of going back to, you can see over here when I was saying that 9 and the 13 EMA. So that's kind of showing you, kind of how to connect some of these peaks and valleys. I'll show you again. We'll just kind of reverse it over here. We'll go back to previous levels. Connecting, again, these candlesticks, every time somebody buys and sells a stock in the world, it creates these patterns, and these patterns form, these candlesticks form patterns, and they form, again, important trend lines, support, and resistance levels. So you can see right here on my chart, that blue line is the 9 EMA. The red line is the 20 EMA. The pink line is the 50 SMA, and the black line is the 200 SMA. So that's what I was showing on the previous slide, right? Just kind of going back over here. Popular moving average lines are the 9 and the 20, and also the 50 and the 200 simple moving average line, right? So if I had the 13 on here, it would be basically in between this 9 and the 20. So if you don't like the 9 and the 20, you could always use the 13. So when price action is above that 9 EMA and all these moving average lines, when all these moving average lines are below price action and price is above, so when price is above all those moving average lines, that's a bullish uptrend. When price starts failing them and falls below them, that's bearish, right? And you'll see again, many of times price will bounce off of these moving average lines like clockwork. They're meant to be used as a guide. They're not foolproof, right? They are lagging indicators. That's why you need to know candlestick patterns. But if you get a nice trend, you can ride it up, and you can see, like, when you start getting these, remember I was saying those like bull flags or those pullbacks, so price action will move up, and then it kind of, let me see here. Kind of like moves up, and then it kind of consolidates back, right? Those flag patterns. Consolidation back here, you get a little entry here, off a small candlestick off that 9 EMA, and then you could wait for a candlestick close below the 9 EMA and leave, get out, right? So you could ride that trend, and when it starts closing below the 9, decide to get out. Watch for reversal candles. I'll show you dip buying in a few moments. We're going to talk about dip buying, but you can use that tight 9 EMA as a ride the 9 strategy, and then kind of let it reset. When price then gets back above, you'll see it kind of fell down here, got back up. What did it do? Kind of like another flag pattern, right? You could have gotten in up here and then rode it all the way to up here, right? As it closed below the 9 EMA. Now, again, this is what I was also telling you. That's the ride the 9 strategy. But I was also saying, right, be aware of reversal candles at tops of trend lines and stuff like that. So you can see, as you're kind of creating, this, connecting these peaks and these valleys, you can see back here. Again, trend lines will shift a whole bunch, depending on your trading time frame and when you're trading. But you can see as price kind of goes up, it comes back down, goes up, right? So it's kind of creating, I can hit these resistance levels up here. When you start to see like way out in the future, so what happens back here also happens in the future. So when you start to see these like kind of reversal candles, near resistance levels, you can see right over here, I can connect back over, some of these levels. When you start seeing these, smaller reversal candles right up nearer to resistance levels, you have to be careful. This is where you would start to maybe, depending on your entry, if your entry's back further, if you've been in for a while and you start seeing these smaller little candles near resistance levels, you might decide to take profits earlier than a close below the 9 EMA. Now, with a stock like Apple, it's going to be a lot less pumping and dumping, right? So typically you can ride a trend for maybe a lot longer than you would with a penny stock, whereas you could get an entry, say back here with a penny stock, it could go up here, and then you could have a nasty candle back down in a day or two and wipe out all your profits, right? So with larger cap stocks, that's where, again, they're more highly liquid, more reputable stocks, so you can tend to ride the trend a lot better. And then when it starts to fail, and you can see these, look for moving average crossovers, right? You can see when they start to cross over, that's when a lot of times you'll see price starts failing these moving average lines. It's kind of trading sideways in a range. And then when price starts to fail, remember, it's like a rubber band. Stocks will, as they fall, they naturally want to snap back up. If price hits that ceiling again, right, and then it fails, then you have bear flags, right? So this is where you could then take the inverse and look for things like bear flags. As price is failing, what happened? So as price is failing, it kind of moves back to those moving average lines, right? So you kind of have a bear flag, and as it rejects, you can take a potential short down here and ride the trend down. And then when you start seeing a close, you know, this is a little bit of a fake out, but as price starts definitely down in here, if you didn't take your profit on this bear flag, this 9 EMA right here, you could have shorted up here, either gotten out over here, or waited indefinitely down here, you would have covered, you know, on riding the trend down, right? So shorting I'll talk about in a few minutes, but there's option strategies. You can take it heading down, or you can do shorting, but this is that riding the trend down on the 9 EMA. It's been obviously due to the coronavirus and stuff like that, really choppy, lots of volatility. Ideally, you'd like to see stuff like this, right? You'd like to see riding a trend up that's really clean and nice up like that, or riding it down. This is a little bit cleaner, you know, it's not as crazy, the candles, so it's a lot easier. You can see this is clearly heading down, right? So comparing to this, all the huge candlesticks, that's why smaller candlesticks are very important for risk management. So again, when price is riding above the moving average lines, that's bullish. When it's failing and it's below, it's bearish. Let's take a look at GE. GE is here's a good example of just the stock has just been failing and falling, right? So when you kind of go in on this, you can see price is just clearly just failing that 9 EMA. That's a clear downtrend, right? Now, before coronavirus, it's been going on for a while. So you can see these, you know, prices failing. It's been going on. You can see bear flags like crazy, right? So bear flag, then you can see bear flag, kind of bear flag, you know, failing down. It just keeps going down, right? So this is in a clear downtrend. But you could also, again, you can use that 9 EMA as a short-term guide. But you could also kind of go back up here and kind of connect. You can connect out to the future over here. You can connect these peaks down over in here. So obviously when it's happening, forget this one right here in the future. You can kind of watch it from over here. So when I zoom in, you could see, you know, I was connecting those peaks, right? They go out to the future. So as price is starting to fail, where is it here? Right on the daily, as it's failing, it moves back up. Trend lines, very important, guys. Not just moving average lines. You got to look at these trend lines. And now when I'm connecting here, it goes out to the future. And even here, like you can see, this plays out to the future. And again, trends will break. You know, new ones will you know, take effect. You can see right here, kind of connecting the, you know, the valleys, connect as many peaks and valleys. So now you can see kind of a sloping megaphone pattern where just price is kind of going, you know, it's riding the moving average lines down. You connect these peaks over in here. Now you're clearly defining that trend, and you're riding the trend up or riding it down. Now, if you're in a if you want to go bullish on GE and it's just in a consistent downtrend, that's where it can be very difficult, right? You want to go with the trend. So let's go next up and take a look at, and SPY, just to show you again, SPY kind of redundant with Apple, right? I showed you Apple, but again, with the SPY, when price is kind of riding those moving average lines up, you're riding that trend up, going back right here as price is failing the moving average lines and it's hitting the ceiling, right? So up here, these moving average lines are support, right? They're a floor. When it starts to fail, they become a ceiling until price can break above it. And then you just, again, you connect those peaks and the valleys. And again, we teach you in our courses how to do trend lines and all that good stuff. This is more of a basic overview on it. All right, so next up, we've got dip buying. So dip buying, you want to look for entries near support levels, typically on daily or hourly charts. Yes, there's other different time frames, but you know, if you're kind of trying to get a good dip buy to get in for a little bit, you know, for a longer period of time or several days, if not several weeks, you want to look at those daily and hourly charts. You want to risk off of small candlestick reversals, things like hammers, dojis. You want to watch for bounces off the major moving average lines. Again, moving average lines are a guide. They're not foolproof, but you'll see many of times those hammers and dojis they'll fall off of they'll fall down to the 50 SMA or the 200 SMA, get a small little bounce, show the reversal where you can potentially get in and get a dip buy, risking off a small candle, and then kind of ride it back up for a potential uptrend. Again, you got to look at the trends and connect your trend lines to see, but you want to risk off of small candlesticks when you're buying low, right? Keep your risk minimum. Now, you also, again, want to watch for potential rejection near moving average resistance lines, like I was showing you with those smaller little candlesticks at trend lines, at the top of trend lines, you know, spinning tops, dojis, stuff like that. And also look for candlestick reversals or trend line breaks to exit. You can use that ride the 9. Again, if you get in, you ride it, you know, you get off a small dip buy, you get back up and you're riding that trend. When price starts to break either the trend line or it falls below that 9 or the 13 EMA, or you hit rejection levels at those resistance levels, that's when you potentially look to exit the trade, right? Let's take a look at a couple examples of dip buying. We'll look at good old Bed Bath & Beyond, BBBY. All right, so you can see Bed Bath & Beyond has just been in this nasty downtrend, right? Now, when I zoom in, there will be, you know, as price starts to fall and, you know, it starts to fail, you can see these bear flags down. At some point, price is going to potentially look to form a bottom and create a reversal. So ideally, you want to try to see, again, timing bottoms. Many a times, you can go to dip buy and it'll trick you out. Right? That's where if you're risking off small candlesticks, if it fakes you out and it's a false breakout and then it fails, you can keep your risk management small, right? So you can see right over here, Bed Bath & Beyond, kind of this whole downtrend. And then you can see this kind of the smaller green candlestick right over here. And this is where the bulls, you can see, might be coming in. They have volume here where it might be holding support. Again, this is also a tweezer bottoms pattern as well. So you can see it's showing a potential reversal. When you see right over here, it's a smaller candlestick. So you would look for a potential entry at a bottom right here as price breaks above this green candlestick, using a candlestick close below as your entry. Then you start watching the patterns. And then you see, okay, as you draw your trend lines, when I was saying trend lines and moving average lines, when I'm connecting these support levels, right, when price breaks the trend, that's when you can consider, again, exiting your trade, taking your profits. You could stay in it technically because price is still holding. So again, it fails and it comes back down and is retesting these levels. You could also take profits out here at this shooting star candle that is happening, what? Right at that 20 EMA. Remember I said pay attention to those moving average lines. A lot of times things will happen or give you early warnings, right? So you could take your profits here on that early warning. You could have waited to here, or if you're trying to be in it longer term, you can see price is still above this level. It's up to you when you're going to take your profits, but you can see it broke that kind of short term trend, that's a few days. That's a 4 or 5 day swing trade. If you got in at 408, you could have been out over here at 4 or 556, right? So that's a what's that, $1.50 or so move. That's a great move, right? Or again, you can look at other things like this may be an inverse head and shoulders, may want to continue up. Again, that's when you can take your profits and then also look for reentries, right? So that's a reversal or an example of a dip buy there. Let's look at some other ones here. Now you can see price is falling right over here. So you can see if you're drawing your trend lines right here, connecting these support levels. That's not a great one. Let's just do it back more like, right? Connecting these peaks or valleys, connecting the peaks. You can see price is failing, right? It's kind of heading down right here. And then you can see right above that pink line right there, that's the 50 simple moving average line. This is where you would look for a potential dip buy, risking off of a small candlestick as your entry. And then you could use a candlestick close below that as your stop. And then you can see as it starts to break out. Now, this is where you decide, right? Do you want to take your profits as it failed the 9 EMA here? Do you take them earlier up here off these doji spinning top candles? So like I was saying, you could, where am I? There we go. You get those earning warning signs as price breaks out, might want to pull back down. Do you take your profits, look for reentry? Do you close your trade here and take profits? Or do you want to stay in it because now you can now connect kind of right over in here. So you can see price is bouncing right over here, continues up, right? Now you can see it starts to break the trend over here, but you could still, if you wanted to, you could kind of move it out this way, right? You have a chance if you dip bought at, and risked off a small candlestick, had an earlier entry, you can ride it up. And then you can see this one kind of took a ride up that 9 EMA, and then it really closed over here. So, but along the way, so this is where you're going to decide, do you want to hold throughout this process? Maybe get out over here. Do you take profits out here? Remember, again, like the rubber band effect, right? When price gets way overextended, it naturally wants to gravitate back. Let's look at a few more examples of these small candlesticks near support levels, right? Price starts to fall right near these moving average lines. That maybe not really necessarily a dip buy, but it's basically a potential reversal, right? As price is starting to fail right here, you can see, these small consolidation candles right above that 50 SMA. This one right here, this is a really nice one right here, that doji candle. This is beautiful. Bear flagging right at the bottom, small little candle. That's like my favorite right here. Beautiful looking candle right there, tiny little candle. You can risk off that tiny little doji candle. And as you can see, here's a perfect example. The next candle went up and then it tricked down. And you see, guys, it was a little bit of a fake out, but it didn't close below that small candlestick right there. It still continued. But that's an example, guys. If you're at a base, many times you'll get that little false breakout. It'll try to shake you out a little bit. But if you are risking off small candles, you could potentially stay in the trade longer. You cut your losses quickly. Again, you got to look at what's happening. Obviously, this is getting buried. But with penny stocks, you're more likely, you got to be more careful because a penny stock you could buy right here and it could just completely drop, lose the base on you, right? So with bigger stocks, it's a little bit less likely for that to happen. What was the next one I wanted to look at? That was Amazon. So Amazon, let's go back over here. You know, again, you can see these kind of these falling channels right here. You can see price is falling. You can see some support potentially starting to hold. Now you have a hammer right here holding that support level. Smaller hammer, you might look to risk off of here. Get in as it's breaking out. Here's a few days. You can see it's rejecting at that 200 SMA, which is previous resistance level. Then you'd consider getting out. As price starts to fall back down again, you look at these little hammers again. Look to potentially get in. As price is failing, what's happening? This hammer is happening near this hammer, you know, previous support level, right? Hammering out a base. And then as it takes off, that's where, again, do you take your profits way out here and look for re-entry? Or do you want to stay in longer, right? If you get in way back here on these smaller candles, you have the luxury to be able to ride it longer. But again, no, Amazon's a larger stock, right? So, you know, again, many times it's nice to, you know, get in, take your profits, look for re-entry. Now, as it happens, many times the candlesticks will get bigger along the way. So the risk gets a little bit bigger because the candlesticks get bigger than they are, you know, back over in here. So let's look at right here. Here's another one. Price starts to fail. Small little green kind of spinning top candlestick right above that pink line, 50 SMA. So price starts to fall. Small little candlestick, risk off of this, right off a support level. As it breaks out, remember I was saying, guys, so as price, like rubber bands, you see those smaller candlesticks way out, or those kind of indecision candlesticks. Stocks are like rubber bands. They naturally want to gravitate back. So do you take your profits out here, or do you wait for a candlestick close below the 9? As you can see, there's a lot more profits you're giving back when a price is at all-time highs. So just be aware of that, right? And kind of like here it happens too, guys. There's like that consolidation. It's kind of almost like a flag pattern. You'll see these little patterns. It's not necessarily a dip buy, but as it's falling back to support, it's those smaller candlesticks, right? So you also look for those as reversals to the downside. All right. So next thing let's talk about is basically like next day pops. So another thing you can do is get an entry long or short near market close during the power hour between the hours of 3 to 4 p.m. Eastern Standard Time. So this strategy would basically, you're looking to get an exit. So you want an entry towards the end of the day for a pop either the next day or within a couple days, right? So it's not a day trade. It's not necessarily a swing trade, but it's kind of like those short-term pops, right? So you're looking for either a potential breakout or a breakdown setup on a daily or 1 hour chart. And you also want to have a good 5-minute setup. And then you look to get your entry on a 1 minute, right? So if you have a good daily and an hourly setup, good 5-minute setup, you get your entry on a 1 minute. Then what you're looking to do, again, is either the next day or shortly after, look for those pops. So instead of trying to chase in the morning, right, like day traders, all the day traders are in there and they're all kind of hunting for the play, getting set up, and at the opening bell, they're all chasing it. You know, if you get your entry the day before, the night before, and the setup's good, you're determining your exit strategy. You're not trying to determine your entry and your exit at the same time. Again, gives you a little bit more time to think. Again, this is for swing trading in general, but this strategy again for next day pops. So if it's also another way to avoid getting hit with a day trade, right? So if you have a small account and you only get 3 day trades within a 5 calendar day period. If you have less than $25,000, you have to make those trades count. Right? So maybe you shift your focus towards that power hour at the end of the day between 3 to 4 o'clock, look to get your potential entries then, and then look to sell them the next day as they pop. Or, if you get a good entry, if you could stay in potentially longer, or again, you're not fighting to get in and out of the trade the same day. It gives you more time to think. All right. Next up, let's talk about shorting. I know you guys are in the chat, have questions. I'm recording this video. The reason why I haven't looked at your comments yet is I'm waiting to the end because I'm going to record this and put it out on YouTube and in our courses. And then I'll get to your questions at the end. So I'm just kind of going through this first so I can record it, not make the video too long, and then I'll get to you guys in a few. Shorting is the inverse of longing. And when you're longing a stock, you buy low, sell high, right? So with shorting, you're selling high and then you're buying low to cover. So, right? If you're buying a stock, let's just say in general, there's limit orders, but just say you bought the ask, right? If you bought the ask to get in the position and then you sold the bid to get out of it, again, there's other ways to do it. You know, you can sell the ask, you can do limit orders, you can do market orders. Again, that's a whole other thing. I just want to keep this simple. With shorting, you're selling high, you get a negative position, and then you buy it back to cover. That it's as simple as that. If you don't know shorting, guys, your broker takes care. It's just like the same as you. It's basically like sell the bid, buy the ask. Again, there's other ways to do it, but if you were like to instantly short, price goes up, you sell the bid at the top, and then you buy the ask to get out. That's a simple way to do it, right? There's other ways with limit orders. Now, you want to take short positions as price reversals happen at resistance levels. And there's a couple different ways to do it. You can short as price rejects the tops. So things might create like tweezer tops. But that's, you know, if you're trying to call a top, there's a lot of people that do it that way. Or you can wait for a candle to fail the previous one. So the second candle, again, if you're depending, I'll show you again some examples of this. Once price fails below that candle, you can use a candle close above that as your stop. So with shorting, again, for swing trading, you want a good daily setup. You want to confirm the hour, the 1 hour and 5 minute charts, even the 15-minute. Look for your entry on a 1 minute. The thing with shorting is you need a good shorting broker to locate shares to short. That could be a little bit tricky. You need a broker like TD. TD is not good for shorting unless it's larger cap stocks. Or bigger name stocks, but things like companies like Interactive Brokers, Speed Traders, Centerpoint, those are really good shorting brokers. So if you're shorting larger cap stocks, E-Trade, TD, they're pretty good, right? But if it's like, let's say penny stocks and you're shorting, and also you have to be very careful. So the bigger brokers are not really great for shorting on like, you know, kind of the lesser name stocks. But be very careful with shorting, especially holding overnight, and also be very careful with biotech stocks because, guys, news can hit, you know, very quickly. So if you're holding more than a day or two, you got to be very, very careful. So the only thing I can just stress is shorting is a very profitable strategy, but be very careful holding more than a day or so. Ideally, you'd like to short. You might get a good setup the previous night, so maybe you get a powered hour setup and then you look to get out the next day, right? Again, everybody's trading strategy is different. I just want to put the expectation that you just got to be very careful shorting. So let's look at a few examples of that, what that would look like on a daily chart. Let's look at Caterpillar, CAT. And where did I do that one? So look for those reversals near tops. This is a little bit bigger one. This is a spinning top candle, but you can see as price is rejecting this peak right up over in here, this is where a lot of people will try to call the tops. So some people would say you could see this green candle right here. On the second candle, as price starts to fail this top, you can short it from trying to call the top down, or you could wait till price fell below this red candlestick, took a short below using a candlestick above as your stop. Now, again, this is where I was saying be very careful. And with shorting, you can see if you didn't take your profit, this is a nice short for a couple days. Then it bounced right back up, right back to your short entry. So now again, you could still be in it because it didn't close above here, but the volatility gets crazy. You never know if there's news or what kind of news there was that day. But if you got a good entry and you took this down, you had a day or two that was pretty nice short, right? Even covering down here, that's a really nice short. You can see, again, here's kind of another one up here. You want to be very kind of careful on those spinning top kind of candles because of the wicks. But as you can see over here, this one right out here, as price kind of moves up, there's just a single candlestick. You could take a short. You can see many times it'll be like a day, right? A day or so, the shorts come in, short it down or set down, and then it's right back up again. So shorting is really good for a shorter term strategy. Just be, again, longer term, you got to be very careful. And you can see, again, as price is moving up, these smaller little candlesticks, as price starts to fail below, you could take a short using a candlestick close above as your stop, and you'll see many people will short price right back down to the moving average lines and then look to cover down here or when they see support hold. You know, here's another one as price kind of moves up. Again, there's other candlesticks. You know, this is kind of a bearish harami. As price starts to fail here, you could take a potential short down. You can see, but many times this is where you got to be careful. As you're taking it down, the next day could be the bulls might be holding it. So this is where you got to think about taking your profits. But if you get a good entry, you know, you can hold it longer, because remember, if you get a smaller candlestick entry, like near resistance levels, right? Here's another shooting star as price falls below it. You know, technically you could still be in this, right? Because price, even in a bounced up here, you know, it didn't close above way out here. But take your profits along the way, right? So that's Caterpillar. I got a couple more examples. Comcast and AMD. There's shorting everywhere, right? But remember, I try to teach you guys these small candlesticks for reversals to the downside, or from dip buying on the way up, and also for shorting or taking negative positions on the way down, right? Small candlesticks near support and resistance levels, very important. You can start to see right over here with Comcast, these smaller candlesticks when price is at all-time highs. So smaller risk, you can see right here, you know, this third doji candle right here, that peak did not break this one up over here. This would have been a really nice short, taking it down right over here. 3 candles, they couldn't break and continue up. And you can see there was previous resistance right over here. And as price started to fail, you can see it went up, tricked around, and boom, you could take this thing short. That would have been a really nice short. You could have been in this one for several days, right? Bottom fell out really nice. But this small candlesticks, very, very important. And last one that I wanted to show you for shorting is AMD. And AMD, you can see, I mean, there's so many, like any time you can see things like as price extends, right? Like rubber bands out here wants to come back, out here wants to come back. When you see it really get overextended, right? You can see the candlesticks get bigger. Ideally, you want some smaller risk, right? Here's one right here with AMD. Here's a shooting star candle, right? As price is failing right here, way out here, take it short and then look to cover. I mean, you could have covered, probably would have covered right down in this area here, but short it down right here, use a candlestick close above that as your stop. Let me see. And kind of up over here, this peak couldn't break this previous peak. So some people will try to, again, a lot of traders will try to call the tops and try to short it as it's not breaking above here, calling the top, or you could wait till it closes below and take a short as it's falling below it, right? It's a little bit, you know, more confirmation, but at the same time, you're also missing some of the move as well. All right, so what else do I got here? I got a couple more things to talk about, and then I'll take your questions. So again, you can do, guys, there's so many different ways to do swing trading strategies. So you can do shares of a stock. You can short, so you can long, swing trading, long shares of a stock. You can short shares of a stock. And then other things is options, right? There's a whole other, I mean, options are just very, very popular ways to swing trade options. There's naked options. It's the most profitable way to trade options, or one of the most profitable ways, but it's also one of the most risky, right? You have to be very directionally biased to do naked options. There's also, again, so you can swing trade naked options. You can day trade naked options. One thing that's really popular, one of the safest things that you can do is credit spreads. So you can sell credit spreads. It's one of the safest swing trading strategies. They're known as call credit spreads or put credit spreads. And call credit spreads are a bearish strategy. So when it's basically, if you were looking to short, right, you would do if you don't want to short shares of a stock, then you might look at doing a call credit spread. Or if you're bullish or looking to dip buy or go long, instead of buying shares of a stock, you might look at a put credit spread. There's other things that you could also do debit spreads as well. So again, naked options are most profitable, or one of the most profitable. Debit spreads are also very profitable. Credit spreads are one of the safest ways because odds are more in your favor being an options seller over an options buyer, because most options expire worthless. And iron condor strategies are really good for range bound markets. Again, this is not going to be a whole video on options. We teach all of this stuff in our options courses on how to trade credit spreads, debit spreads, naked options, all of that good stuff. But just to show you here on a chain, if I went to Apple and I went up to trade, you'll see here's an options chain. And, if I was to do, let's say, a credit spread, if I again, you choose your strike, right? So if you just right click, I'll just choose any of these down here. Just right click. You would, instead of buying, you would right click sell vertical, right? If you did it right over here on the call side, this would be a call credit spread. If you did it on the other side on the put chart, if you right click sell vertical, that would be a put credit spread. Again, we teach you there's so many different strategies you can do with credit spreads, guys. Take our options course, but I just wanted to show you kind of on a chain where you would do a credit spread. If you were to buy, a naked, let's say you were choosing directionally biased, again, naked, you would just right click buy single. Now you're buying a call, right? So call means you believe price is going up, right? If you go over here to the put side, right click buy, now you're buying a put, right? So that's more directionally biased. And as you guys can see, there's so many different strategies that you can do with trading options. But that's just kind of, with credit spreads, kind of one of the safer ways to swing trade. Also very popular. But again, if I was talking to you about options, we have 2 courses just explaining options alone, never mind all of our next level advanced options videos that we've done. So last thing I want to talk to you guys about is weekly options. That's kind of again, you can day trade weekly options, or it's, pretty decent for kind of do that real quick, like sell the pop or, hold for a couple days, 2 to 5 days. But it's kind of like you're not looking to use, put out all the capital risk, right? So you can you can trade highly liquid large cap stocks without having to put out all the, the capital. Ideally, you want to look at a tight bid ask spread, ideally under 10 cents, max 20. Again, that's just my preference. I like to keep my risk management very small. You can trade at the money, so at the money options. Look for high open interest and volume. Again, you want to be very careful holding. Volatility can rip your head off. And, you obviously take your profits, look for entry. Trading weekly options is a very popular strategy. So it's kind of you can, again, do it day trading, but you can do it like short-term swing trading. Give yourself like a week out or so. So again, you can see when I'm making this video, I probably wouldn't necessarily look at tomorrow's. I'd go out to a weekly, maybe a week or so out, take a look, and then you start to look, at the money or near the money. And then you look right here again, bid ask spread. Now it's after hours, so it jumped a little bit. When I was looking at apples, it was tighter. But you can see right now, after hours, the range is, it's a little bit wider. It's definitely wider than I want. So again, 10, 20 cents maybe max, but you're basically looking to get in on these and you're trading these quick, right? You're in, you're out. The volatility is very, again, it'll rip your head off, especially if you choose the wrong direction. So again, you don't just go, hey, oh wow, like I'm brand new to trading. Let me just go buy. I just believe Apple's going to go up and let me just buy. Oh, well, Apple's, if you look right here, if I go, you can see kind of as I go out further in expiration, oh wow, well, Apple's much cheaper only a week away. So let me buy then. Well, it's because time's not on your side if you're going naked and you have to choose that direction right. So, and a lot of people, you'd be surprised, a lot of new traders will come in, they'll be like, oh, let me buy what's cheaper. Oh, let me buy it way out here. I'll buy way out here because Apple's only $2.78 and they don't have a clue how an option works, right? So that's where, again, just kind of showing you guys the concepts of it. It's a very profitable strategy with weekly options. You just have to do it right, right? So that's kind of, again, the high level overview on swing trading. Again, if you need more help, we have courses on our website. We have several different courses. We have a trade room where we have several different mods that teach all the different trading styles, especially with swing trading. We teach futures, we teach options, we do penny stocks, all that good stuff. And again, if this video helped you, we'd appreciate it if you like it, share it, and comment on it. And you'll find our social media links below. So again, this video will be part of our course, and make sure you take the rest of our course if you want to learn more about swing trading. So hopefully this video helped you, and we will see you in our community. Enjoy.